Well, looks like the balance of economic power in the world is shifting. China has surpassed the U.S. as the world's largest trading nation. Here are the figures from last year, recently released by the Commerce Department. We're talking about imports and exports in the year 2012. As you can see, the U.S. totaled $3.82 trillion. China was at $3.87 trillion. This now another sign of China's growing economic influence. Meanwhile, in Russia, the central bank has gone on a golden shopping spree. This, according to a recent report from Bloomberg. The country has added 570 metric tons of gold to its reserves in the past decade, making it the top buyer in the world. So as other countries continue to strengthen their economic competitiveness, is this a sign of a weakened U.S. dollar? And if so, what does this mean for the U.S.? I'm joined by Gerald Celente, publisher of the Trends Journal. Now for more, Gerald, nice to see you. So China's GDP is half of that of the U.S. So how does a country with a much smaller economy have a larger trading volume?
China's in the business of business, and the United States is in the business of war. China's energies and talents are going into making more at lower prices and exporting it around the world at high profits, while America's energies are going into military industrial complex and making sophisticated weaponry, waging wars. So you can't do both. It's either, it's guns or butter. I didn't make that line up. So the United States has lost its competitive edge because of its military expansionism. And secondly, it's as though the whole nation is living with attention deficit disorder. If they go back to NAFTA back in 1994, when it was first pushed through, many people warned that this was going to happen. It was that great sucking sound. It wasn't only going to come from Mexico, it was going to come from around the world as U.S. manufacturing shipped its jobs overseas to cheap labor countries to bring the product back and sell it at a markup. So it's very easy to see, and the consequences were predictable.
So it's no secret that the U.S., a large chunk of the U.S. budget goes toward military spending. And a lot of people say that this is what's propping up the economy, but you're saying this is doing the opposite.
Oh, absolutely. There's that mentality that still exists. America and the world, the Depression ended when World War II started. And stupid people say things like, we need a good war to get us out of this, which of course is an oxymoron. But the defense budget goes to a very small group of individuals. It's a monopoly in those industries. And when you look at the real numbers, Liz, defense and defense-related spending is over $1.2 trillion.
All right, Gerald, so we see China now, #1, the world's biggest trader. And as a result, China is becoming a very important trading partner for many countries. So at this rate, will European countries be doing more trade with China than with other European countries?
Well, Europe is not out of their depression. By the way, they don't call it a depression in Spain with 26% official unemployment, same in Greece, very high numbers in Portugal and Italy. No, they're not going to be doing a lot of trading with anybody because there's also the currency war problem. And you're seeing the value of the euro going up. That means their exporting products are going to be more expensive to buy. And you're seeing at the same time with the new Prime Minister of Japan, Abe, saying to the Bank of Japan, print more money, buy more government treasuries and securities, and lower the value of the yen so we could sell more product.
Now, there's this term. We mentioned China now the biggest trader, Russia now the biggest buyer, and there is this term. It's coined the BRICS. We're talking about Brazil, Russia, India, China, South Africa. This group of emerging economies, can we expect this group to continue to grow? And if so, how will that impact the global economy as we know it?
The problem with a number of the BRIC countries is that there's also the exporting issue. So if economies slow down, you take Brazil, for example, they're a big natural resource exporter. So if the Europeans and the Americans aren't consuming, that means Brazil exports less product into China. And of course, India and Russia, of course, also being a big natural resource exporter. And then you have slowdowns coming from India and China, and South Africa, although they're now a BRIC nation, again, a very small player, but natural resource exporters. So if the Europeans and the Americans aren't buying, the Chinese aren't making, the Indians aren't making, and the natural resource nations aren't exporting. So we see this continuing to slow down. The BRICS aren't going to build it up.
Interesting, Gerald. Always interesting to have you weigh in. That was Gerald Celente, publisher of the Trends Journal and director of the Trends Research Institute.